All right, so next in our list of budgets, we are going to be going over the budgeted cost of goods sold statement. Um, this one is usually the one that I personally like to test on. So I would caution you to spend some time understanding this one. When I say test on it, um, I mean, this is the one that I actually want you guys to be able to write out because it is a statement, it is very important, and it's one that you've actually seen quite a few times. And it is just basic cost flows. So the first thing that we typically start with when it comes to our budgeted cost of goods sold statement is we grab our beginning work in process inventory. And since we're starting off this period, oh, by the way, we are going to use 3 columns for this one. Since we're starting off this period with the first month of operations, this will be 0. Next, we're going to need our manufacturing costs. And keep in mind there are 3 manufacturing costs. The first one being direct materials. Remember, this is our raw materials. Now, for our raw materials, it's not a straight number. We are going to show the cost flows involved with our raw materials. So the way that we do that is basic cost flows again for raw materials, very similar to what you learned in your earlier chapters. So beginning inventory is for raw materials. Then you add in your purchases. Whatever you get there, that is your materials available. I think we usually call this available for manufacturing. Then we go ahead and take out any ending inventory, and then whatever is left over, that gives you your total direct materials cost. And essentially, if you remember this from the first few chapters, that formula, that's your direct materials used. So that's the cost that you remember you're using in your manufacturing costs. So let's go ahead and pick out that information. So beginning inventory, beginning raw materials inventory is 0 because it is the first month of operations. When it comes to the raw materials, our purchases, remember what are our raw materials for this company? It's the mahogany and the oak. So which budget do we need to go to grab this information? The direct materials budget. So on the direct materials budget, notice that we plan to spend $80,775,000 on mahogany and $23,722,425 on oak. And remember, this is going to be a budgeted cost of goods sold statement for the full quarter. So we're going to need that total amount that we plan to purchase. Add those 2 items together. That gives us our materials available for manufacturing. Next, we are going to have to less out our ending inventory. Now, if you look at our direct materials budget, you'll notice that the ending inventory, which month are we going to grab our ending inventory from? March. You might remember that I had a big ol' hubbub about whether or not we should be making these ending inventories for the final month or not. But if we did, the math wouldn't work nicely in this total column. But keep in mind, if we're talking about the end of the quarter, this is the ending inventory. But it's not in dollars, it's in feet. So what we're going to have to do in our formula is we are going to separate it into 2 parts. So the mahogany, we plan to have 20,500 feet, and that's at $5 per feet. Let me actually bring this down just a wee bit so you can see my formula up here. But then we also have oak. Oak is going to be 10,400 at $4.50 per feet. So once we find the total cost of mahogany and the total cost of oak, then we will have our monetary amount for the ending inventory. Now that we have that information, I'm going to move to the middle column because this is where our 3 manufacturing costs are going to go. The materials available for manufacturing, that's the materials available for use that you might remember from our first exam, minus ending inventory. There's our total direct materials cost or direct materials used. Next, we're going to need our next manufacturing costs, which is direct labor. Let's go up to our direct labor budget. Total for the 3-month period, $16,836,000. And then our last one is going to be that manufacturing overhead. So we can go to our manufacturing overhead budget, and there's our total right there. All right. Add those 3 items up to find our total manufacturing costs. All right. Now that we have our total manufacturing costs, let's go ahead. We could do an intermediate one, but our textbook likes to skip right to the ending work in process. So let's take our ending work in process inventory. Now, if we take a look at our problem, let's see. The company, one second. All right, the company plans to have 0 work in process inventory at the end of the month. So 0 ending work in process. And when we go ahead and we deal with that flow, you might remember that gives us our cost of goods manufactured. So this formula is our beginning work in process plus our manufacturing costs during the period minus any ending work in process. So that gives us $121,572,500 for cost of goods manufactured. And then here we do our final cost flow, which is the cost flow for finished goods. So we have our cost of goods manufactured. So we're going to add in our beginning finished goods inventory. Which this is the beginning of the first quarter of operations, so that's 0. And then we take out any ending finished goods inventory. Now this number right here is the one that everyone hates because it's not totally self-explanatory. So we know how many units we have in finished goods. Let's go up to our production budget. It says our production budget says that in March we have desired ending inventory of 18,750 units, but we need to know the cost of those units. So what we're going to have to do is we are going to have to find out the cost per unit. So in order to do that, we already know the total production cost that we had during the period. Let's grab those ones. And then for those costs, we know that we spent $121,572,500 to produce a total of 350,750 units. So if we just did that right there, all on its own, I know I don't need parentheses, but it helps kind of understand. We would see that the cost per unit is $346.61. 1 second. They were so quiet for so long. All right. So now that we have our cost per unit, all we have to do is multiply this by the ending inventory in finished goods, and that's going to give us our total dollar value. So if we go up to our production budget and we look at March, we see that we expect to have 18,750 units in ending inventory at the end of the quarter, which is the end of the final month. So that gives us $6,498,886.32. All right, now that we have this information and we know the ending finished goods inventory, we simply have to finish up our final flow to find cost of goods sold. All right, so started with beginning finished goods. I know it's a weird order, but it just makes me more comfortable because of cost flows. beginning finished goods plus whatever we added minus whatever we have in ending. That means that we must have sold $115,073,613.68 worth of inventory during this first quarter. So yes, a very successful quarter for this individual. All right, the last one that we want to take a look at is our budgeted income statement. You know, it's just a tease that I keep deleting them. Now, for our budgeted income statement, we've already covered most of it. Let's go ahead and put in our budgeted sales revenue. Our sales revenue, let's go up to our sales budget. We plan to have $166 million. And then we have our budgeted costs. So we have some costs of goods sold, which we have actually already covered right there. And then if we look at the problem, Jeremy does not anticipate marketing and administrative costs to be very high during the first quarter of operations. $10,000. Very unrealistic, but let's go with it. That'll be a whole different meeting that we will have with Mr. Jeremy. All right, so our total budgeted costs, add together our product costs and our period costs. Hope those phrases make sense. And now once we have our budgeted costs, let's go ahead and find our operating profit. So I hope by now we know the difference between sales and costs. Should give us our budgeted operating profit. Still really good. That's amazing. And then we're going to have to deal with income taxes. Federal and other income taxes. All right. And for our taxes, Professor Carlson Meyer so kindly estimated those taxes for you. $13,175,111.22. And that leaves us with our budgeted profit after taxes. So really, Jeremy is looking at a pretty successful first quarter if everything goes to plan. $37,741,275.10. So those are all of the budgets that we would have typically gone over if we were together in class. You'll notice me just going through them took about 45 minutes. So you can imagine if we sat through in class and I walked around the room and waited for you guys to attempt to do it, we could really use up a full probably 2.5 hours of class time. So I do encourage you to spend some time taking a look at these. If you have any questions, please let me know. And keep in mind the one that I usually put on the exam for a written problem is going to be this cost of goods sold statement. The others are usually built into some type of multiple choice for Chapter 13. All right, so good luck with everything. Let me know if you have any questions.